Welcome to this session on Indian Accounting Standard 102, Share-Based Payment. In this video, we will cover the core concepts, types, accounting treatments, and key examples under this important financial reporting standard. Indian Accounting Standard 102 governs share-based payment transactions. It applies when an entity receives goods or services, including employee services, in exchange for shares, options, or other equity instruments, or where the payment amount is linked to the company's share price. There are three main types of share-based payment arrangements. First, equity settled, where the company issues shares or options. Second, cash settled, where payment is made in cash, but the amount depends on share value. Third, arrangements where either party has the choice of settlement in equity or in cash. In equity-settled transactions, the fair value of shares or options is measured on the grant date. This cost is recognized as an expense over the vesting period, which is the time an employee must serve to receive the shares. Once the fair value is fixed, it is not remeasured later. Let's look at an example. Suppose a company grants 1,000 stock options to an employee on 1st April 2023. Each option has a fair value of 100 rupees and vests over 3 years. The annual expense will be 133 rupees for each of the 3 years. In a cash-settled transaction, like share appreciation rights, the company does not issue shares. Instead, it pays cash based on the increase in share price. These liabilities are remeasured at fair value at every reporting date, and the expense is spread over the vesting period. If the employee has the option to choose between shares or cash, the arrangement is treated as a compound financial instrument, part liability, part equity. If the entity has the choice, the most probable outcome is assessed and accounted for accordingly. Conditions attached to share-based payments are critical. Service conditions require the employee to stay for a period. Performance conditions can be market-based, like achieving a target share price, or non-market-based, like meeting sales goals. Market-based conditions are included in the fair value. Non-market-based conditions affect how many options are expected to vest. If the terms of a grant are modified, any increase in fair value is recognized over the remaining vesting period. If options are cancelled or forfeited, any unrecognized expense is reversed unless the cancellation is replaced with a new grant. During the vesting period, the company records debit employee compensation expense, credit share-based payment reserve. When the options are exercised, entries include debit bank and the share-based payment reserve, credit share capital, and securities premium. Some important reminders. Use the grant date fair value for equity-settled awards. Cash-settled awards must be remeasured at each period end. The vesting period determines how the expense is recognized. And remember, option pricing models like Black-Scholes are often used to value share options. To summarize, Indian Accounting Standard 102 ensures that the cost of share-based compensation is fairly presented in the financial statements. Understanding the type of award, the vesting conditions, and valuation method is essential for accurate accounting.